There is a number sitting in most people's bank accounts right now that is quietly losing value every single day, and almost nobody notices it happening. It is not because the number is shrinking. It is because of what that money could have been doing instead. Picture two neighbors who each have exactly $100,000 saved up. One of them uses every dollar to buy a house outright, proud to own it free and clear, with no mortgage payment hanging over their head. The other puts down a small amount, takes out a mortgage at a low fixed rate, and keeps the rest of that $100,000 working somewhere else. On paper, the first neighbor looks like the responsible one. But stay with me for the next few minutes, because by the end of this video, you are going to understand why that so-called safe choice might actually be the more expensive one, and why some of the wealthiest people you know almost never pay cash for anything big. Why? Paying cash feels safe, but costs you more. The idea of paying in full feels good because it feels final. No bank calling, no monthly bill, no interest ticking away in the background. But here's the part almost nobody stops to calculate. The moment you hand over that $100,000, it stops being money that can grow. It becomes a wall, a roof, and a foundation. Those things are valuable, but they do not pay you back next month the way an investment account can. Economists have a name for this. It is called opportunity cost, and it simply means the value of the next best thing you gave up in order to make the choice you made. When you lock $100,000 into a house instead of letting it sit in an account earning returns, you are not just buying a home. You are also quietly giving up every dollar that money could have earned somewhere else over the next 20 or 30 years. That gap is invisible, which is exactly why almost nobody accounts for it. What a locked up $100,000 really means, let us make this concrete for a second, because numbers on a screen only mean something when you can actually picture them. If that same $100,000 had instead been placed into a simple, diversified investment account, averaging even a modest annual return, it could realistically grow into something 2, 3, or 4 times its original size over a couple of decades. Meanwhile, the house you paid cash for is worth what the market says it is worth, nothing more. And you cannot spend a hallway or cash out a staircase without selling the whole thing or borrowing against it later anyway. So here is the re-engagement question worth sitting with. If both paths lead to owning a home eventually, why does one path also leave you with a second pile of money and the other one does not? And this is not just a house scenario either. The same math applies to cars, to renovations, to paying off a low-rate student loan early instead of investing that money, to any situation where you have the choice between handing over cash today or keeping it flexible and letting time work in your favor. The mortgage rate story. Everyone forgot. Let us talk about something that happened not long ago, because it is the clearest real-world proof of this entire idea. Back in 2020 and 2021, mortgage rates in the United States and Canada dropped to some of the lowest levels ever recorded, with plenty of homeowners locking in rates around 3% for 30 years. Anyone who paid cash for a home during that window gave up the chance to borrow money at a rate cheaper than most credit cards, cheaper than most car loans, cheaper in some cases than inflation itself. The people who instead took out a mortgage at that rate and invested the rest were effectively borrowing at 3%, while their investments had the potential to earn far more than that over time. That gap between what you pay to borrow and what your money can earn elsewhere is not a coincidence. It is the entire engine behind why financially savvy people rarely rush to pay things off early when the interest rate is already low. The same pattern shows up across Canada too, where fixed rate terms locked in during that same low rate window are still paying off for the households smart enough to keep their cash working instead of throwing it all at the balance the moment they had extra room. How inflation quietly erases debt. Now, here is the part that almost nobody explains, and it might be the most important idea in this whole video. So, stay with me. Inflation does not just make your groceries more expensive, it also makes fixed debt smaller in real terms every single year. Picture a 30-year mortgage payment that stays exactly the same dollar amount from the day you sign until the day you pay it off. Your income in a healthy economy tends to rise over those decades. Prices for everything around you rise too, but that mortgage payment does not rise with it. 20 years from now, that same monthly payment will represent a smaller slice of your paycheck than it does today. In other words, time and inflation are quietly working together to shrink the real burden of that debt, even while the number on paper stays frozen. People who pay cash never get to benefit from that slow, invisible discount. People who finance at a fixed rate are essentially locking in today's dollars to pay off tomorrow's cheaper obligation. Think about it this way. A monthly payment that feels manageable today will likely feel almost small 15 years from now, not because you paid it down faster, but because everything else around it, your paycheck included, grew while that one number stayed frozen in place. Why two people with the same income handle debt differently? So if the math favors borrowing at a low fixed rate, why does almost everyone still feel terrified of debt? The honest answer has nothing to do with math and everything to do with how stable your income actually is. Someone whose entire paycheck depends on a single job with no other income streams and little in savings is right to be cautious because one layoff or one medical emergency could turn a manageable payment into a crisis. That fear is not irrational. It is survival instinct doing exactly what it is supposed to do. On the other hand, someone with multiple income sources, a solid emergency fund, and predictable cash flow can absorb a bad month without the debt becoming dangerous. This is the real dividing line, and it has nothing to do with being rich or poor. It has everything to do with how many directions your money can come from if one of them dries up. This is exactly why two people earning the identical salary can look at the same low-interest loan and reach two completely different, completely rational conclusions because their real financial picture underneath that paycheck is not identical at all. The one question that actually determines your real debt tolerance. Before you decide whether debt is a tool or a trap for your situation, ask yourself one question. If my main source of income disappeared tomorrow, how many months could I comfortably cover this payment? If the honest answer is less than 3 months, that is valuable information, and it means building a stronger cash cushion should come before taking on any new low-rate debt, no matter how good the math looks on paper. If the honest answer is a year or more, then the opportunity cost conversation from earlier in this video becomes far more relevant to you, because you already have the safety net that makes low-interest debt a reasonable trade rather than a gamble. This is not about copying what wealthy people do just because they do it. It is about understanding the actual conditions that make a strategy safe or reckless for your own life. Someone earning a modest income with rock-solid job security and a paid-off car might have more real debt tolerance than someone earning triple that amount with unpredictable commission checks and zero savings cushion and no amount of impressive numbers on a paycheck changes that underlying truth. What this means: the next time you write a big check, the next time you are staring at a big purchase and debating whether to pay it off entirely or keep some cash on the side, do not just ask yourself which option feels safer. Ask yourself what that money could be doing if it stayed liquid. Ask yourself what the interest rate actually is compared to what your money could reasonably earn elsewhere. And ask yourself honestly how many months of stability you actually have if your income took a hit. Being debt-free is not automatically the smartest move, and being leveraged is not automatically reckless. The real skill is understanding your own numbers well enough to know which choice actually serves you. Most people spend their whole lives treating debt and cash as a simple moral choice, good versus bad, responsible versus risky, when really it is a math problem wearing an emotional costume. Once you strip the emotion off and look at the actual numbers, the interest rate, the inflation rate, the return you could realistically earn elsewhere, and your own income stability, the right answer usually becomes obvious. It is rarely the same answer for every person or every purchase, and that is exactly the point. The goal was never to convince you to rush out and borrow money. The goal was to make sure that the next time you are handed the choice between paying in full and keeping your options open, you are making that decision with the full picture in front of you, instead of just going with whatever feels the most comfortable in the moment. If this broke down something you have never had explained clearly before, stick around, because the next video takes this even further.